And joining us now here in studio, Hank Cunningham, fixed income strategist with Odlum Brown and the author of In Your Best Interest, which of course is a good name for a book about trying to make some interest. We wanted you in here today because of what's going on around the world. We needed some real good old-fashioned financial literacy 101. So you're the bond expert, the bond guru as they call them, so let's do some of that here.
Sure.
What's a government bond, Hank?
A bond that's issued by any government to fund a deficit, typically. It's an IOU. And in Canada, for example, you and I are the credit of Canada because we pay the taxes that support the interest payments that they pay to the bondholders. So a government bond is unsecured by anything physical. It's only secured by the good faith and credit of all of us taxpayers.
So when the government goes into deficit to pay for all the things that we say we want, they have to go to the markets to borrow that money.
Correct.
And those bonds are the IOUs.
That's correct. They're promissory notes that, but most of them are owed to each other. Like Canadians own 80% of the bonds that are issued by the government of Canada. 20% are owned by foreigners.
So let me just get that straight. The government of Canada, I think, is about $550 billion in debt right now. And we owe 80% of that?
Canadian investors own 80% of those bonds.
We own 80% of those bonds?
Either institutions or individuals, yes.
Is that a good number?
Yes, it is, actually. Better number is 100%. But in the old days, before Paul Martin slayed the deficit, we were up to almost 50% owing money to foreigners. And then after all the surpluses that they ran up for all those years, they paid down debt, and foreigners had no bonds to buy because the government was actually paying off bonds instead of issuing more of them. So the foreign ownership declined to where it is today, about 20%.
Why is it better to owe the money to ourselves as opposed to people who live somewhere else?
Well, then there's no risk of currency loss. If you pay interest payments to a foreigner and your currency goes down, it costs you a lot more to service that debt. And they also have some control over you because if they all of a sudden, as the Japanese did once upon a time, decide to sell all your bonds at once, that causes havoc in your internal bond market, as we've seen in Europe.
Why couldn't the people who live here make the same call?
They could, and they do, and that's what happens. Where countries like Canada and France, where there's very little foreign ownership of our bonds, somebody dumps a lot of bonds, our investors just buy them, and so there's no real threat to our credit markets because of the strong nature of our domestic markets.
Okay, so we've been talking about government bonds at the moment. Those aren't the only kinds of bonds out there.
Correct.
Corporations float bonds as well. How are they different?
They're a lot different because you're only getting the faith and credit of the corporation itself as your credit. And credit rating agencies, whatever you think of them, exist to assign a rating to these corporations as to how likely you are to get repaid. And the word credit comes from the Latin credere, which means to believe. This whole thing is one big belief system. You believe you're going to get paid back. But a corporation is restricted to its own balance sheet and its own earnings, whereas the government of Canada can raise the taxes on all of us to pay for its sins, so we say.
Well, I like the way you put regardless of what you think of the credit agencies. Because, of course, 2 years ago, they all disgraced themselves with how abysmally they misrepresented and kind of misdiagnosed all of the bonds that were out there, or many of the bonds that were out there. So do we need a rethink about the value of corporate bonds?
We do. The credit rating agencies, I think, have really disgraced themselves. But unfortunately, we need some kind of a rating system because, for example, BBB is the lowest possible rating that a prudent man can invest in. Below that is considered to be high yield or junk, and therefore much higher risk. So you need, and a lot of the pension funds and insurance companies have to have a BBB rating or higher to buy bonds. So if a credit rating agency lowers a rating from BBB to BB, they have to sell those bonds. So there has to be some kind of standard, but I can tell you from my experience that institutions in Canada have their own ratings internally. They disregard the public rating agencies because their work is following. The horse left the barn's locked, and they decided to downgrade something long after the market's already figured it out. So they're really ex post facto.
So as we look at the risk, a government bond is less risky than a corporate bond. There are others who float bonds as well, though, right? Cities float bonds if they want to get stuff done?
They used to in the old days. Small towns would do it, but now they're lumped together with these large rating, like Ottawa Carleton has a regional authority which borrows money on behalf of all the municipalities in its area, similar to Waterloo. There's all kinds of regional municipalities that have good credit ratings because they have broad taxing powers on all their citizens. But Canada has taxing power on everybody.
Yes, they do. What makes a government decide when to issue debt or how to issue debt?
Well, they use the Bank of Canada as its agent in the marketplace. And one thing that's important to know is that the Government of Canada bonds are the benchmark for all other securities, and they're used to price other securities. Everything's priced in relationship to Government of Canada bonds. So it's important for the Bank of Canada to issue what they call benchmark securities at the key maturity dates, 2 years, 5 years, 10 years, 30 years. So province of Ontario, for example, will price its bonds in relationship to the appropriate maturity of Government of Canada bonds. So the Bank of Canada has to orchestrate the borrowing of this money to try and keep the marketplace liquid, not to issue a lot of small little issues that don't trade, but to make them large and liquid for both domestic and international investors to trade easily, and it's a very, very liquid market, by the
So
way.
let's do a real life example here. Last year, when the budget deficit federally was $55 billion, how does it work? The finance minister goes to the Bank of Canada and says, look, I got to go out there and borrow $55 billion to meet our requirements this year. Will you go float some bonds for us, please?
That's pretty much that's the simplistic version of it, but the Bank of Canada is the agent for the government, and in concert with the government says, here's what we're going to do. We're going to issue so many treasury bills because the yields are very low. So if we issue a lot of T-bills, it won't cost the government as much money. We won't issue as many long-term bonds because the yield curve is steep, so the shorter the maturities, the more we save you. But we do want the maturity of the debt to be at a relatively decent average term, so we'll issue some long-term bonds too. And they consult with what they call the major primary dealers that the Government of Canada and the Bank of Canada employ. What do you think? When should we come to the market? What kind of maturity should we use? So there's a constant discussion between the Bank of Canada, the government, and the marketplace as to which issue should come out now.
Okay, Hank, the marketplace.
Yes.
Who is that?
Marketplace, the bond market is a giant market. It dwarfs the equity market, trades 20 to 40 times the daily volume of the stock market, and is 20 times the size of the equity market. It's largely invisible to the man on the street. It's a decentralized market. And the example I use in my book is that TransCanada Pipelines has 500,000 shares outstanding, or maybe it's 500 million shares outstanding, whatever it is, a large number of shares. It's easy to find a buyer and a seller all day long in the Toronto Stock Exchange. But TransCanada has 65 different bond issues, ranging from 3 years to 30 years with different features on them. They don't trade every day. You can't post a market on them. So the market trades what we call on an over-the-counter basis, where dealers make markets as principals, whereas the stock market acts as agents. You go to buy 100 shares of Bell, you're going to be buying it from somebody else. When you try and buy one of the Bell bonds, there may not be a market for that bond, and the dealer will have to short it to you or suggest something else, because the bond market just doesn't have the same ease of agency transactions that the stock market does.
But there's always going to be a market for Government of Canada bonds?
Always. Yes,
Always.
Always.
Somebody out there is always going to want to buy it?
Yes, sir.
Why?
Because they need liquidity and safety. And the bond market's all about getting your money back. It's a market of principles. And so I call it the sleep at night approach, where you want to get your money back. And as people age, the demographic bulge is moving on. They want more comfort. They want sleep at nights mentality.
And we're very safe.
And I provide them that safety with the portfolios that I designed for them. Yeah.
How much do we have to pay them in order to loan us the money?
The rate changes, of course, with two things: supply and demand and inflation. And so we've had very little inflation in the last several years, and interest rates are very low right now, uncomfortably low for lenders. This is a borrower's market, not a lender's market. The borrowers are winning right now. So there's not enough interest rate yield here to give people enough income really right now, and rates are going to have to go up significantly for seniors and other savers and lenders to get an adequate income.
Significantly means what?
Oh, 2 or 3% higher than where they are now. And they're going to go there, I think. But nevertheless, right now the interest rates aren't generating enough income for lenders.
Okay, but again, just trying to figure out what this all costs us. Jim Flaherty goes out there, he says, I want to sell $55 billion worth of debt. How much will we have to pay back once we get that money?
I'm sorry, how much we have to pay back?
Well, if they loan us the money.
What's it going to add up to?
Yeah. At the end of the day, it's $55 billion this year, but we got to pay that back someday, right? To all the people who bought the bonds. What do we have to pay them back to get that $55 billion right now?
Well, the average yield on, if that's what you're asking, what the average interest rate that we're paying on this debt right now is probably 3 or 4%, very low.
Okay.
Because T-bill rates are near zero and long-term rates are only like 4%. So maybe it's even under 3% probably.
Manageable.
Manageable, definitely. And there's also a real return bond market that is a better measure, perhaps, of answering your question. These are bonds that are indexed to the rate of inflation, so they measure how much overinflation these bonds are. Right now they're 1.3% over inflation. Inflation's 2, so the answer is 3.3. So I think we're in that 3% area.
Now you said for savers, the rates right now are uncomfortably low.
Yes, they are.
For governments, the rates are great, aren't they?
They are.
Because they can borrow money and not have to pay that much more back, right?
And of course, the reason they're low is because of the recession, which caused inflation to go down and rates to go down. And then the borrowing requirements went up because when recessions hit, revenues go down, and unemployment insurance payments go up, and all these other payments go up. So the deficits get magnified in times like this. So borrowing goes up, but cost of money goes down.
35 years ago or so, when interest rates were 20%?
That was 1980, 82.
80, 82?
Yep,
okay.
that's when rates
So
hit
about
24%. Yeah.
Right. So back then, if you were a government and you wanted to float some bonds,
you were in trouble.
that was bad news.
That was really bad news. And a lot of them stuck to borrowing short-term bonds, though. And that was a good thing to have done, because as time went on and rates went down, you were rolling over your bond issues at lower rates as time went on. The lenders, if they were smart enough, bought long-term bonds, and they had this 18% coupons for 20 years. So, But that's part of my job, is to make sure they buy the right things at the right time.
Gotcha. How attentive are governments to the market in which their bonds are traded?
Very, very attentive. They really have the spotlight on it. The Bank of Canada, as agent for the Government of Canada, is constantly in touch with the marketplace. The Government of Ontario, similarly. All the 10 provinces are factors in the bond market too. They all have deficits to fund. So they're glued in. Their treasurers are right on top of this market every day. Ontario, for example, just borrowed money in the Japanese yen market. Ontario has a big deficit. They have to borrow wherever it's efficient for them to borrow. So.
And they went to the Japanese yen market because why?
Because they'd have to borrow so much money that the Canadian market started to tell them, you should go somewhere else for some of your money, because it's just too much for our market to bear. So this can happen.
So the Canadian market said, well, we're not satisfied that you're going to pay us back, and therefore you should go somewhere else?
It's just that the spreads are too wide. You can borrow the money less expensively somewhere else in Canadian dollar terms.
I see.
So
okay. Here's a nice term that we heard a lot over the last couple of years, because it was one of the reasons why we had the financial meltdown. Credit default swaps. Insurance policies in some respects, right? What are they?
You just described it, and there's no way to describe this in any simple terms that the man on the street's going to really understand. It's insurance against default. If you own a bond and you're worried about defaulting, but you don't want to sell it, and you think the market's a bit shaky on the bond itself, you go and pay through a derivative contract, a swap-related contract. You buy insurance, and you pay premium fees to the issuer of these derivative contracts in the event of default. You pay them so many fees per quarter, and if the issuer, the entity, defaults, you get the full value back of the bond, even though it might be worth 20 cents on the dollar. And the reason why credit default swaps are important, because they measure what the market thinks of the default risks for the various entities. Like Greece had very, very high default credit spreads, and Germany almost zero. So it's a good measure of what people think is going to happen to these entities.
It's a decent insurance policy as long as everybody's paying their money back.
Yes.
If everybody defaults,
the game's over.
Game's over.
Yeah.
House of cards falls down.
Yeah. So it's a derivative contract, and it's usually the smallest ticket would be 20 million. So it's not something the man of the street is ever going to buy.
Mm-hmm. Okay. Let's talk just in our last minutes here about debt. I think I used this number earlier. Since 1867, when we became Canada, to today, various governments, through spending year over year over year over year, have accumulated $550 billion, roughly, plus, of debt. And you said 80% of that debt is held in Canada.
Yes.
Who owns it?
The government agencies themselves own it. The Bank of Canada has a pension fund. The pension fund industry is a large consumer of bonds, as is the life insurance industry. Life insurance industry needs long-term bonds because they have long-term liabilities. Their annuities and so forth. They match 20-year bonds with their insurance policies. Mutual funds, ETFs, individuals.
ETFs?
Exchange-traded funds, sorry. It's a new feature of the markets where these funds have to go and they mimic the index of whatever bond index you're mimicking, and you have to buy the bonds that underlie that index. So they buy Government of Canada bonds for the Canada index, and so on. So, and individuals, just 5%, they constitute 5% of the bond market in Canada.
Individuals only represent 5% of the bond market.
Yep, 95% is dominated by the institutional buyers, banks, insurance companies, mutual funds.
In a healthier economy, are those numbers different?
No, it's pretty much been consistent over the years. The average transaction size is $50,000 for an individual in the bond market, and that's what our firm does, is specialize in servicing smaller investors, and that's why I wrote that book.
Got to get the plug in, right?
Absolutely.
That's what they say. Got to get the plug in.
Sell.
You mentioned, all right, 80% of that debt is held domestically, 20% overseas. Would it be better for our economy if it were 100% held in Canada?
Absolutely.
It would be better.
Sure.
So then why does the government of Ontario go over to Japan to get debt rather than try and service it here?
Okay, I better make one point clear, Stephen.
Sure.
If the Government of Canada issues Government of Canada bonds in Canadian dollars, there's nothing to stop Japan from buying those bonds. It's not considered a foreign bond in that case. It's a sovereign bond because it's a domestic bond owned by a foreigner. So that's different. They can buy all the Canada bonds they want. And of course, it'll drive our dollar up, which is a good thing. But in issuing bonds in yen, then the province of Ontario is taking the stand that rates in yen are very low, and we think the Canadian dollar is going to do well against the Japanese yen. Or you wouldn't do it. If you thought the yen was going to rise against the Canadian dollar, it would cost you a lot to do that transaction. Or they'll swap the money back into Canada at a lower rate than they could have borrowed at in the Canadian market. And that's one of the most important reasons why they issue in foreign currencies.
But is it a goal of finance ministers to look at that split between how much debt is held domestically and how much foreign, and aim to get the domestic debt up as much as possible and the foreign down as much as possible?
I would phrase it differently. I think their goal is to land the cheapest cost of money for their citizens. Okay. If Ontario decides that if you swap the yen proceeds back to Canada and that rate is lower than they could have borrowed in Canada, they're going to do that trade all day long. And if it's the other way around, they'll borrow domestically. So that's a strong reason why they do this, just to keep their own cost of funds as low as possible, so the opposition critics can't lambaste them for spending too much money on
Not to
interest
mention the
payments.
taxpayers.
Not
who
to
want
mention
them
the taxpayers. who
watch
want
the
to-
bottom line as well. Okay, in our last minute, let's talk about this. We love our country. Bondholders don't give a damn about love of country, do they?
No, they don't.
Should they?
They should. The average Canadian is going to retire in Canada, and he's going to need Canadian dollar income to retire with. So he doesn't care about foreign bond markets, only to the extent that they might affect capital markets in general. So if you're going to retire in Canada and your RSP was full of bonds and other Canadian dividend-paying stocks, you would want to keep that in Canadian dollars, because then you have no currency risk at all. But you say, Hank, well, I'd like to buy some of those cheap Greek bonds in euros. And I say, well, you tell me where the euro is going to be against the Canadian dollar when you need the income, then you go ahead and do that. Because that spread, that interest rate advantage is going to get wiped out very quickly by currency movements. Unless you're going to retire in France or in the United States, where you would need euro income or dollar income, I advise Canadians to stick to Canadian dollar bonds.
But one of the things we've learned over the last couple of years is that the bondholders, in some ways, are more powerful than presidents and prime ministers, right?
Well, I'm reminded of the time when President Clinton promoted a very fiscally irresponsible budget. And the bondholders, we were called vigilantes at that time, ganged up on him, drove bond prices down and yields up, and he had to retract his fiscal irresponsibility and come up with a balanced budget instead. So the vigilantes are always watching bad governments and we discipline them and punish them when they step out of line.
In Your Best Interest, The Ultimate Guide to the Canadian Bond Market is your book. Hank Cunningham, we thank you for coming in for a little financial literacy one-on-one when it comes to bonds and debt and all that other stuff.
Thanks for having me.
Thank you.